Should we care that China's property market is accelerating its meltdown once again? Or is this just something happening over in a corner where we shouldn't or need not care or need not worry? Well, let's find out. Welcome to Macro Money. This is Ilya Spivak, head of Global Macro here at tastylive. And we are going to have a look at another round of worrying headlines coming out of China and take a little bit of an early look at what it might mean as we get some more catch-all data coming out that will be crossing the wires from that area over the weekend. We're not going to get a chance to talk about it, of course, because markets will be closed and we won't be here. So we'll take a look at it now and see just how much all of this impacts broader markets and what the level of contagion seems to be. So the first thing that we, of course, need to look at in this calculus is a bit of stage setting. So let's go there and see how the actual market response is looking. So this is an index, evaluation index of real estate owners and developers on Chinese equity markets. So this is listed in either Shanghai or Shenzhen, which are the two big bourses. For the record, the bourses themselves are on track to be down 1.2% so far after 2 days of trade this week, which puts them on course for the lowest close since back in the pandemic period. So we're really looking at some outsized weakness here, but this particular chart focuses in particular on what's happening in the property sector, where really from the middle of 2019 or so, what you see is a topping and an accelerating decline. The interesting part here, of course, also that the decline is only very briefly interrupted by the reopening toward the end of last year. You can see that slight pop right here. And now we are approaching levels suggesting that the situation is at least as bad as it was during the worst of COVID. So we are now in really in really profoundly sort of negative areas, at least as far as the valuation aspect of this is concerned. So very clearly the situation for the property market in China is deteriorating. The latest moves here, which you see on this chart, come from yet another worrying headline from China Evergrande Group that's coming to us over the course of the past 24, 48 hours, where these guys who are one of the largest developers, or were one of the largest developers in China, missed yet another bond payment. This was an onshore bond payment, and they, of course, were already in the midst of a huge restructuring effort after they'd missed a bond payment back in March. Since then, we've had similar issues at a place like Country Garden, where really the situation has been over leverage on one hand, lack of demand on the other. And of course, if nobody is buying what you're selling, if the price for housing is coming off because nobody is buying it, well, then as a developer who used borrowed money to build up inventory, that's a major issue. Because when your inventory doesn't sell, you can't then pay down the loans that you used to build it. And then you get into trouble. Then you start missing bond payments. Now, the issue seems like something episodic. But a look just a little bit broader, and it starts to look very much like an endemic issue for the economy writ large. When you see here that the price for housing has actually been going down about the same as have the shares going back to about the middle of 2019. You can see that red line peeking out there. So you can see here that there's the valuation index. It's mostly flat until a peak sometime in sort of the middle of 2019 or so. So we're talking about this right here. And then when we flip forward to where housing prices are, well, that's that same peak right there. In the yellow bars here is a Bloomberg housing price index done as a diffusion measure. So at 50 out of 70 reporting cities, it's about half and half reporting price gains and price losses. Below 50, it's mostly reporting price losses. Above 50, it's mostly reporting price gains. What we see now is that we're at about, give or take, 25, 30% reporting gains, which means that we're at about 70, 75% reporting losses. So what we're looking at here is a large-scale decline in the housing market, in the property market more broadly as well, of course. And largely, the issue seems to be that economic growth is just not feeding demand as it existed before. And the sort of thing that for really the past few decades has been a driver of a tremendous portion of China's economy, by some estimates anywhere between 35 and 25% of GDP is in this property sector, that this is now going away as a lever of growth. Now, much of China's business model for the past, let's call it 20 plus years, maybe a bit longer, has been not even the export and the value add engine that so often is credited as the main way that China does business. And indeed, this is, of course, a critical bedrock of the economy. We have the importing of raw materials, inputs, semi-finished things from a whole variety of markets, and then the usage of China's abundant resource, labor, to either finish those prefab items or to transform them from raw inputs into finished products, or again, semi-finished ones, and send them on. So China has really been a kind of node for value add work in the global supply chain. And that, of course, has been critical. What has really made Chinese growth much faster and much more amplified has been that on the basis of that model working, what China has done is then borrowed tremendous sums internally to have a massive infrastructure build out all across the country. Cities, bridges, airports, railways, all of it. And this has been a huge source of employment, a huge source of investment. Most Chinese investment portfolios are very strongly leaning toward the property sector. And all of it now seems to be starting to unravel in a meaningful way, or at least to have hit a very significant headwind. And the threat here is, of course, acute. So here's the sense that the underlying economy seems to be struggling with. So if we look here for the impact of China's reopening from COVID restrictions, as reflected in PMI numbers. These are Purchasing Manager Index numbers. They give us an estimate of economic activity growth. They're more timely than GDP, and they work on a similar diffusion index sort of framework where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. What you find here is that China's main customers, in its role as a global supply chain node, reopened much faster than did China from COVID lockdowns, and so had these massive bursts of catch-up growth, both from lingering stimulus efforts. They did a tremendous amount of stimulus in both the U.S. and the Eurozone, the main markets that power China's export engine. And then, of course, all of that burst of reopening momentum with a very generous helping of stimulus on top, both fiscal and monetary, generated inflation. So the bursts of catch-up growth in the U.S. and Europe seem to crest somewhere around the middle of 2021. And of course, shortly thereafter, central banks, led by the Fed, but of course also in the Eurozone and frankly most of the G10, embarked on an aggressive tightening cycle. So growth had already peaked and then was driven down lower, not only by normalization forces, but by the active cooling effort of central banks seeking to bring inflation down. China reopened in December of 2022, some 18 months after growth had crested for its main customers. And of course, 18 months after means also that those markets have had both the need and the time to start to diversify supply chains. If China was closed and they were reopening, they didn't need to generate deliveries for goods being demanded somehow. And so there was a rerouting of supply chains. On top of that, of course, growth was already cresting, so demand was already starting to come in. So by the time China reopened, its hopes of seeing demand look anything like the pre-pandemic normal were, of course, dashed. So the reopening has been, to a large extent, a dud. There was a brief pickup in service sector activity once people got let out of lockdown and were able to travel and go to restaurants and move around. But it has now fizzled, and growth is slinking back toward at least neutral, flat levels, if not yet in outright contraction, as opposed to, let's say, the Eurozone, which, as we can see here, is actually in contraction mode already. You can see the impact that this is having in terms of sapping demand, because no work, which would be the prerequisite to making more GDP, making more economic growth, the absence of demand, the absence of work being demanded, understandably hurts when it comes to consumption, hurts when it comes to employment, encourages a more spendthrift perspective from consumers, encourages a general slowdown of the economy. And we can see this in spades when we look at the latest GDP numbers. This is the spread between nominal and real GDP. And of course, the difference here is that when you look at real GDP, you are looking at nominal numbers discounted by inflation. In a very peculiar set of circumstances, not what you usually see. In China, real GDP now surpasses nominal GDP, which means that to get from nominal to real, you actually have to subtract something. That essentially real GDP minus a negative rate of inflation would have to be the case to come down from real GDP to nominal, which is not the usual course of things. Typically, you take nominal GDP, which is higher than real, you subtract from it positive inflation, and get down from nominal to real. This is a flip of that. Now, this, of course, is a bad thing because what it says is there is no pricing power in the economy. The price of things economy-wide seems to be falling. Now, that is, of course, a reflection of demand. Why do things go on discount? Because nobody is buying them at the price that they are at, and so prices have to fall for things to get bought. This is a economy-wide signal that there's virtually no demand of substance, or at the very least that demand is very much trending in the wrong direction on net. That we now have implied deflation at a scale of 1.5% as of the second quarter. That, of course, doesn't bode well for the housing market, doesn't bode well for consumers, doesn't bode well for the entire pie. When you consider that it's those consumers you want to be buying houses, which is 25% of the economy, which is the reason you're getting a meltdown at a place like Evergrande to begin with. Now, Chinese authorities have tried to do something about it, understandably, but those efforts have mostly fallen flat. So here we have new loans and total loans, and these are year-on-year growth rates. We can see that in the latest data, they've finally reached a tad bit into positive territory. We can see in particular the total loans number here has jumped into positive territory for the first time in 3 months here, having been below zero here, here, and here, and has now jumped to here. So finally, we're looking at some slight growth here. New loans also returning fractionally into positive growth territory, but this doesn't seem to be really moving the needle. And of course, the trend still remains lower, which we can see in spades looking at Chinese financial conditions. We can see here, even with easing efforts, even with some modest rate cuts, some efforts to ease restrictions on borrowing, to ease restrictions on home buying, to inject capital directly into the banking system, we are still on the tighter side of the spectrum for Chinese financial conditions. This is a gauge from Citigroup, and what it's showing us is that relative to average, which is zero in this framework, we are tighter. So credit is more constricted as opposed to less constricted. So all of these efforts that Chinese authorities have put forward to try to Western-style flood the market with liquidity and turn illiquidity into liquidity and wake up the housing market, give consumers the cash, give businesses the cash to go and spend and lift growth, that sort of thing has proved to be elusive because conditions remain on the tighter side, and of course, there is all the low growth and property market turmoil to show for it. Still more worrying is market's expectation that this is not going to get much better. Now, in fairness, we can see that since reopening, the implied policy curve has flattened quite a bit, which means the market is, in fact, baking in or has been baking in a degree of stimulus, and that stimulus has come to some extent. There's been rate cuts. As we've just said, there's been injections of capital into the banking system. There's been mandated reductions in banks' reserve requirement ratios, which should make more cash available to lend. Any number of things, but Worryingly, we can see the yield curve is now pointed firmly higher. It's sloping up. So as you get from shorter term maturities, call it the current policy rate out to 1 month to 3 month, and then out to 2 year, 3 year, rates are higher in the future than they are even in the relatively near term. And so you don't get the sense that what you're looking at is a curve biased toward more easing, like you might see, let's say, last year, going into the end of the year for the euro area or the Fed. There is the expectation that there is going to be cuts that are coming to reflect the downturn in growth seen ahead. That is not what we're looking at here. The markets are a little bit flatter versus where we were in December. And of course, now we're getting close to a year since the reopening has started. We still got a few months left, but we've gone most of a year since then. And we do see the curve has moved lower and flattened to show that the reopening has largely missed the mark, and more stimulus was needed and has been offered. But the path forward isn't encouraging because it doesn't look like there's very much more of it that's on the cards here. And so the response from markets has been exits. We can see here the amount of money in foreign currency deposits in China, so foreign investors holding money in China to ostensibly allocate into the local economy, that's been plunging down to, at this point, less than $1 trillion from a peak of $1 trillion. So we've dramatically declined. We're at the lowest levels since right before COVID. And what that's done on top of it is put a ton of pressure on the exchange rate. So we can see here the value for the yuan expected by markets relative to the dollar, which is the orange line here, and the one that is set by the central bank every day as a kind of benchmark, the daily fix that's in the red, have diverged dramatically. And that's as the market is betting on a weaker yuan. So orange line going higher is the dollar getting stronger against the yuan. That's the yuan getting weaker. The market expects to see a weaker currency as all of this capital outflow is taken into account. And Chinese authorities are desperately trying to stem the flow and ease the pressure on the currency. But of course, we can see now what this is costing them. There has been a tremendously yawning gap in between these things, reflecting the degree to which Beijing authorities are trying to swim upstream here, because capital is in fact exiting. Liquidity conditions in large part because of that are still quite constrained. Just saw that here. Capital is plainly leaving because the prospects for some sort of a nearer term improvement have dimmed. Now, as promised, over the weekend, we're going to get a set of updated Purchasing Manager Index numbers. And here we are expecting to see just a hair of improvement. The picture for manufacturing looks like it's going to get basically to standstill from contraction territory. And we're looking at shallow improvements in services and the composite index. Worryingly, of course, these numbers are awfully close to standstill. And furthermore, we still run the risk of downside surprises. In fact, if we look at city data for Chinese economic data's performance relative to forecasts, we can see here that it's still sitting below zero on this surprise index, suggesting that data still tends to undershoot relative to forecasts. Now, you might take solace in the index getting a little bit higher here from about mid-July, as if to suggest that perhaps the margin by which the data is undershooting is narrowing, and so perhaps there is a bit of improvement, but alas, not so fast. This is an index that's constructed not in terms of absolute outcomes, but relative to expectations. It can improve either because the data has gotten better or the expectations have gotten worse. So the data is having an easier time meeting them. And indeed, the expectations have gotten worse. As a matter of fact, they got worse at about the same time that the performance in relative terms has started to improve. So you can see here, July 17th is where this index bottoms. And then from about July 20th, so mere days later, is where you get the meat of a more pronounced downshift in Chinese GDP growth expectations as tracked by a Bloomberg survey. Looking at now about a 5% growth rate for this year and something on the order of 4.5% next year. That's very slow by Chinese measures of what is normal in recent years, where growth rates of 6 or 7% are what is typically on the menu if we look back into the pre-COVID period, let's say 5 years or so, maybe even less. Now, all of this seems to suggest that maybe these PMI numbers might still actually surprise on the downside and might well be pointing in that direction. Because whatever improvement we have in relative data performance is coming not from the data getting good, but from the expectations getting worse. So the story seems to all, as it were, feed onto itself. Now, the problem here, from a broader perspective, from a global perspective, is, of course, that China is a commanding part of the global economy at close to a fifth. And that impact is actually underreported by looking at just its own contribution, because so much of the global economy are vendors for China. So if we think about Australia, which has a business model primarily centered around digging up whatever can be dug up in Western Australia, loading it on a ship and shipping it to China. New Zealand, most of Southeast Asia, a very large component of South America, all have strong linkages and dependencies to Chinese demand. And so when you consider the impact, it is profound. That, of course, comes at a time when the Eurozone is already flirting with a recession, if not already in one, and the U.S., while still a little bit more resilient, is facing down a Federal Reserve that seems absolutely laser-focused on inflation and has signaled emphatically that if it's got to hold rates higher longer to achieve its goals, which of course are to squeeze the labor market in the U.S. sufficiently that you lose enough work that wage agreements are reset through layoffs, and inflation is to some extent unstuck and is allowed to come in closer to 2%, the target that the Fed is aiming for, you're left with a situation where the global economy doesn't have much of a leg to stand on. And these latest headlines out of China merely reinforce the idea through the lens of the property market that absent a strong China, absent a Eurozone now in recession, and absent a Fed that is, and absent a U.S., I should say, which is actively being slowed by the Fed, the global economy seems all but certainly on a path towards some kind of a coordinated downturn. This, of course, bodes ill for stocks, probably is supportive for continued U.S. dollar gains, may become supportive increasingly for the Japanese yen as liquidation gathers steam. And as we look forward here, seems like an issue that won't be going away quickly. Now, of course, the absence of growth is in this sense self-reinforcing, because minus demand, given slowing demand further in external markets and in domestic markets, like in China's, in particular because consumers are losing the support from the housing market and the property market, which, as we just said, is an overwhelming part of investment portfolios and employment and the key engine for growth over recent years. The global recession story just gets that much worse. And the likelihood for continuation gets that much more probable. All of which sets up weakness all around the risky and the cyclical asset universe, be it stocks, be it commodities like copper and to some extent crude oil, be it higher yielding and commodity linked currencies like the Australian and the Canadian dollar, and bodes well for defensive assets, the dollar, bonds, to some extent gold, to some extent silver. And of course, in a broad-based risk aversion, to some extent, the Japanese yen, Bank of Japan inaction notwithstanding. And that is macro money for today. We were absent yesterday. We're back. We'll be back for the rest of this week. We're usually here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio, head of futures and Forex here at tastylive, and increasingly Dylan Radigan as well. So do join us for that. I'm back on with Chris for Futures Power Hour on Fridays, with Tom and Tony for First Call on Sundays, opining on the news and insights portion of tastylive.com. As a matter of fact, the write-up of this very conversation and this very analysis is there now. And also issuing pithy commentary here and there on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. See you tomorrow. Happy trading.